So today I have Omar Chowdhury with me on this special edition of the Hoxton Life. Omar heads up the fixed income and multi-asset team at Aditum. Prior to Aditum, Omar was at Union National Bank, and prior to Union National Bank, he was at T3 Trading in New York. He's the fund manager of our adventurous and moderate funds that we run for clients, and these are strategies that we have. You'll be able to see these in your portal, and there'll be the lines with view assets, and you can click on and you can see it expand out more. It's essentially a basket of low-cost tracker funds that Omar and his team manages for us. And the reason we hold these funds is so we can make changes to the asset allocation very quickly and very easily in times like we're going through today, while obviously, of course, remaining invested. So it's really great to have Omar here with me. I thought today would be great to record a video so you guys can obviously understand the changes that Omar was making prior to the tariff tantrums and what he's been doing very furiously, I imagine, over the past few days, and what we're potentially looking at going forward. So without further ado, I'll hand this over to Omar. As I said, it's been a manic few days in the markets. We've obviously seen big drop-offs Thursday, Friday last week. We saw things pick up Monday, Tuesday. We're here Wednesday. Over our shoulder, we can see Asian markets have opened lower. Talk us through, let's start prior to Liberation Day. What was you doing? How was you gearing the fund up, or the funds up at that point?
Yeah, challenging times for sure. Period of very heightened uncertainty, heightened fear, panic that we haven't seen in a long time. I think the last time was probably March of 2020 when the COVID pandemic set off. Prior to that, it was December 2018 when the first trade war happened, and then it was 2008. So let's start off with the beginning of the year, right? So coming into this year, markets knew there could be a tariff situation on the horizon, but they were largely ignoring that. They didn't really buy the fact that Trump was going to get aggressive with tariffs, right? The economy was pretty strong. They were focusing on the positives, tax cuts coming through, pro-business president, pro-stock market, everything. Stock market kept on making new all-time highs. We had that DeepSeek announcement in January. That was the only kind of correction or disruption that we had in markets. AI and tech stocks corrected off the back of that. We had a tilt towards that sector, so we got a bit hit over there, but we made some changes in the portfolio to kind of mitigate those losses. And then we were running positions in equities that were about neutral to slightly overweight up until mid-Feb to end Feb, when I think the market suddenly woke up to this reality that Trump means business. He's going to put on tariffs. And this might actually snowball out of control. Now, the speed at which this has happened and the magnitude, I don't think anyone really predicted, like reciprocal tariffs across the board, the level of tariffs coming out, and then the speed of moves that we've seen in the equity markets are just like unbelievable, right? So what we did in the first week of March, when we realized this situation could get out of control, we rapidly dialed down our equity exposure. So that's dialing down risk asset exposure to about 10% below neutral. And with a specific emphasis of dialing down US, because that's where the highest risk was, that's where the highest, most expensive valuations were, and we cut a lot of our tech and AI exposure. And as you know, that's actually led the sell-off in terms of sectoral performance. We rerouted some of that money into European and Chinese equity markets. They're faring pretty well, holding up relatively well compared to the US, but eventually everything has caved, and we've seen 20% drops across the board. We remained underweight in equities. What we've done also is that we've held a 9% position in gold. Gold has been a pretty good safety hedge in the portfolios based on, gold acts as a safety in portfolios in times of fear, but also there's been a huge wave of central bank demand driving gold higher. So that's actually benefited the portfolios quite immensely. The other thing that we have done is rerouted some of that capital into a flight to safety trade, so treasury bonds, right? So treasuries typically in this environment become the risk-free asset or a safety asset. And that hasn't been too easy either, right? So treasury yields have, for the most part, been coming down from January peak, but it's been very volatile. And if you look at what's happened from Friday till now, they've actually sold off quite aggressively, right? So now we're in an environment in the last 2 days where stocks are going down and bonds are going down and gold is selling off, right? And just to wrap it up, like the reason that's happening is because there's a lot of deleveraging that's going on in portfolios. So margin calls are forcing clients to sell everything across the board.
So talk a little bit and help people understand margin calls, because we've kind of seen this whipsaw effect. Yeah. Like, first 2 days we saw big sell-offs, Thursday, Friday. Monday, Tuesday, relatively positive, and again we've opened down. So just explain that impact and that what's happened.
So margin trading or leverage is basically it's taking out leverage against your equity capital, which private banking clients do, hedge funds do, asset managers do across the world, right?
Yeah.
So if you put down X, you get 3X loans, you invest that into the market, right? But there is a certain level below which if assets fall, the one providing the leverage will actually call back capital, right?
Yeah.
And the way you have to raise that capital to actually meet that margin call is sell assets in your portfolio, right? When everyone starts doing that, that's a big snowball effect, right? And it perpetuates kind of out of control. And that's what we've seen end of last week. Up until the lows of Friday, we saw a bounce on Monday, Tuesday. It's just a bear market bounce. Nothing just moves in a straight line down. The bounce was actually perpetuated by this false news that Trump might actually give a 90-day grace period for tariffs.
Yeah.
That ended up being false news. People got really excited. They jumped into equities. Shorts were covering. They sucked in a lot of buyers too. But we anticipated that was going to be short-lived after confirming that the news is fake and the fact that we think there is more downside because this whole tariff situation just began. It's not going away anytime soon, right? And what has happened is that it's perpetuated into a trade war between China and US, and they're going tit for tat right now. I don't think that's going to stop anytime soon. So until that gets resolved, markets are going to remain in a fear mode. And probably the sell-off continues.
So we talked about you were underweight in equities before this had even began. So our positions weren't typically, on weight. So, help people understand a little bit what you mean by overweight, underweight.
So we do benchmark the funds, right, to an equity and fixed income benchmark.
Yeah.
The equity benchmark is MSCI World Equity Index, and the fixed income is the Bloomberg Global Ag, which is the most comprehensive fixed income index you can find in the world. And the way we blend those indices are different for each of the two strategies. Adventurous is 75-25, moderate is 60-40, right? So anything that's below 75 overall in equity is an underweight compared to the benchmark. Anything above 75 is considered overweight. And the same thing in the moderate with respect to the 60 line, right? And fixed income is 25 and 40. And then within that, we look at the regional exposures. So the benchmark weight in US for adventurous is 55 and moderate is 40. We went 15% below that, right? So overall equity underweight, within equities, a pretty big underweight in US as well.
Yeah.
And what that does is if you're underweight and markets fall quite dramatically like they have, that cushions the blow. You're still going to lose money. It's still going to go down. But the relative performance is supposed to be better than what the benchmark is going to do.
So what are you looking for when you are looking to go back into equities and invest, maybe go to an overweight position? So when would you be looking to do that? Or are you kind of like, right, we're going to be hands off for the next 6 months. We're really cautious with what's going on in the fund and we don't want to take any of that extra risk on.
Yeah, so we are cautious. We're still cautious today. We're probably going to remain cautious for the foreseeable future, which could be a week, 2 weeks, right? To see how this whole thing resolves itself. Maybe by some miracle, China comes to the drawing board and is like, listen, guys, this is getting out of control. Let's get to a resolution. That's probably not happening today and tomorrow. But until then, we'll probably remain underweight equities, right? But our underweight level might change. So coming into Friday's lows, we were about 10% underweight. Now, we thought that if this market rips in our face, i.e. rallies, it can rally 6-7%, right?
Yeah.
A market that's fallen 20% can easily go up 6-7%, which it kind of did. We don't want to be caught too much underweight as well, right? Because that leads to an underperformance compared to the benchmark. So we reduced that underweight to about 5, right? That's where the active management comes in, just to kind of make sure that we're not caught off guard. But then when it hit the resistance level and started selling off, we actually sold on that position as well, right? So we're kind of playing defensive, but guarding ourselves to make sure that we're not caught out when the market does start to rally. But to answer your question, when are we going to actually go aggressively into stocks? I don't think that's anytime soon, right? It just depends on, one, how this whole tariff thing evolves, 2, what the Federal Reserve is going to do to support markets, and 3, how much the markets actually fall and what they're pricing in. Right now, they're pricing in about a 50% chance of recession, maybe 60. If that goes to 70, 80, 100%, that means they've priced in pretty much all the bad news. There's nothing left to price in on the downside, right? That's usually when you want to lean back in. Yeah. And we'll be very gradual. We'll get slowly to neutral and then start legging in slowly to get to an overweight position once we feel that markets have bottomed out. Yeah. And then the uptrend will be probably taking its time as well.
Very interesting. I mean, I think what's super interesting for me, and obviously how we construct our portfolios is, yes, we do hold, a large chunk in our strategies and our moderate and adventure strategies based on clients' risk profile. But as you know, and around that we would hold typically passive funds, that invest in the underlying markets. There is no way as a financial planner that we can be this active with it. And I think at the moment it really shows the power of this, being able to amend, we've got what, is it 310 million, 320 million, I think, in the fund.
Yep.
That's a lot of assets that we can move very quickly and very easily for clients to take advantage, and so they're not caught out on that, which is really key. I think the message is that although you are not seeing any changes being made to the actual, inside your platform, within the fund, there are changes being made daily.
A lot.
Probably a lot.
We're as active as we've ever been since we took over the mandate. And these are the times that actually call for a lot of active management. So constantly moving weights around, making sure that you're playing defense, make sure that you're playing a bit more offense when markets do bounce, making sure that, you're rerouting capital to the right places where you can actually protect yourself and flight to safety trade. When that stops working, which it has in the last 2 days, you're moving money out of that, maybe more into gold, maybe just sitting in cash for a while. So these are the kind of things that we have to kind of actively manage on a daily basis. And there's a lot going on underneath the hood, like you mentioned.
And we've obviously got the liquidity funds as well, the GBP one that you run for our clients as well, or Aditum runs for our clients. Talk a bit about that, because we've obviously seen that tick up slightly.
Yeah.
I think it was 10 bips over the past couple of days. So, why is that a good hold at the moment when there is a lot of uncertainty?
Right. So when you have uncertainty, kind of which we're seeing right now, one of the safer assets to get into are developed market government bonds.
Yeah.
Right. So that's US Treasuries, that's UK gilts.
Yeah.
That's European bonds, German bonds, or European government bonds, right? And if you're in the shorter part of that curve, that's actually the safest part to be, right? Because the long end, like 10-year Treasury, 20, can be quite volatile, right? But like 1 to 3 year Treasuries are actually pretty safe, right? It's a cash proxy. So the liquidity fund that we manage are UK short-term government bonds, right? Gilts, up to 1 year out. So the safest place you can be in UK assets. And it acts as a cash proxy, and that's where people flock to earn a little bit of return while keeping their capital safe. So, the chances of default there are pretty much zero.
Yeah, it's as low as you can get, isn't it?
Yeah, it's as low as you can get. And you earn something like that's comparable to putting your money in a bank, for example.
And what I think is really interesting as well is that, in no point have you said, we're slightly underweight and then we would look to go slightly overweight equities. We've talked about gold as an alternative asset class. But I think ultimately we do run a multi-asset strategy, which means we take into account lots of different assets and how they're built up. But in no point have we said sell everything to cash. So I think that's the retail investor, that's their biggest thought at the moment is, I need to panic and get out. That is obviously not great because you lock in a lot of losses during that time. And, most people sit on the sidelines for way too long. They're not trading it as you guys are, which is obviously very important at the moment, that people don't panic and don't make rash decisions. Volatility is a price of admission in investing in equities.
It is. And, as the mantra goes, volatility breeds opportunity. And this is one of the classic times when that has to hold true, right? But you shouldn't put all your eggs in one basket in one go, right? So we gradually lean back into the market once we see the factors developing that would tell me that the market has bottomed out. And that all depends on the resolution of government policy and tariff policy as well. There has to be some catalyst that drives that. But also I think there's so much uncertainty around whether we go into a recession or not. And a lot of that has to be priced in still, right? Right now, everyone around the world is repricing risk assets according to how they're going to get hit by tariffs, right? And that repricing is still ongoing. We think there could be some more downside, but we think overall this is going to end at some point. It's going to be a really golden opportunity to leg back into the market for the next 5 to 6 years.
It's funny, isn't it? Because we haven't seen prices on some assets this good since COVID.
We haven't.
And it's naturally, everyone now looks back at COVID and goes, "Oh, I wish I'd have bought these. I wish I'd have done."
Exactly.
You're kind of like in this hindsight 2020.
When you get a lot of clients wanting to hit the panic button, that's another indicator that maybe we're near the bottom.
Yeah.
When panic is at its maximum, and we're almost there.
Have you been looking at flows in the markets?
In some of our funds, people are actually looking at this as an opportunity, right? Yeah. All the calls that I had going into the call, I thought it was going to be the worst call ever, right? Trying to handball, make sure clients don't head out. But they're like, no, our clients are looking to add actually more to the funds. And I was like, okay, we're actually thinking about it the right way.
Yeah.
And, you won't catch the exact bottom. You never do. But even if you're within a 5 to 7% range and you start building a position and you look 5 to 6 years out, you're going to be pretty happy about that in my view.
Yeah. Yeah. It's good times.
Yeah.
And what's the saying? Is it bad investors panic, Good investors do nothing, and great investors lean in. So volatility. So look, Omar, that's been super, super useful. We keep it nice and short for clients who are potentially panicking. The key is that we're not sitting on our hands. We're not doing anything. We are actively looking at this and monitoring it and ensuring that we are positioning the funds in the right way and your portfolios are being managed effectively. As always, if you need anything or you want to speak to us about it, please contact your advisor or contact us, or you can contact me directly, chris@hoxtonwealth.com. And obviously, we'll be running these more frequently now with Omar if we continue to see volatility like this continue, which is highly likely given the fact that Donald Trump is a pretty irrational kind of guy. So yeah, thanks very much for tuning in. Hope you found it useful, and see you soon.